Good morning. Welcome to Market Monday for December 1st, 2025. Yes, we are officially in holiday season. Oh yeah, it's me again, AI Chad. Not to worry, we'll be back with you in human form next week. In addition to the holiday season being a special time of year, it's also a special time of year in markets. In fact, it's the most likely month of the year for the S&P 500 stock market to be positive, up over 73% of the time. Since 1950. But do you remember last year December was down? Can it go down 2 Decembers in a row? In markets, anything can happen. And in fact, the last time the S&P 500 stock market was down 2 Decembers in a row was 2014 and 2015. Moving over here, we see that historically speaking, since 1950, December had not only been up most often, it was also the strongest month from a returns perspective. However, it lost that title recently, as we see, here's the returns since 1950, the past 20 years here, and the past 10 years. A clear trend in a weakening December over time. Does that mean we're doomed? Again, we always want to zoom way out. And while we want to address current events and narratives here at Market Monday, we don't want to focus too much on the short-term gyrations of the market. Zooming out to still a short-term time frame of less than a year, the S&P 500 stock market has been up 7 months in a row. We can see that streak has only happened 10 other times since 1950. So it has been a really good 7 few months. And the streaks don't get much longer. So when the pullback inevitably comes, and the media starts ascribing reasons for why the market was lower in a particular month, that's when we really need to step back and regain our perspective. In fact, here's a look at every pullback of 5% or more in the S&P 500 stock market since the March 2009 low during the global financial crisis. Debt crisis, you see this? European deflation fears. World Bank sees negative growth rate. Recovery is ahead of itself. My goodness, do you know anybody who would want to swing at that pitch again? So whatever the headline, the narrative, we would encourage you to see that not as a threat, but as an opportunity. Think one of the narratives might be an AI bubble? Time will tell, but at least for now, it appears many of the parallels between the current AI infrastructure build-out and dot-com bubble in the 90s are simply not true. Here's one measure of valuation, P/E ratio. When the line goes up, stocks are getting more expensive. You can see here, it's gone nowhere this year. Might not be a cheap stock market, but empirically, we're not seeing runaway valuations. Here's another look. In blue, we have the so-called four horsemen, the market darlings of the 90s internet boom: Cisco, Microsoft, Dell, and Intel. And in orange, the Mag 7, today's market darlings. This is the same P/E ratio we looked at, so line up, higher valuation. You can see, going into the bubble peak, the P/E ratio of the four horsemen skyrocketed north of 80 times. 80, before bursting. By contrast, the P/E of the Mag 7 has leveled off below 40, which you can see is around where the four horsemen leveled off after the bubble burst. One thing we are keeping our eye on, however, is how much of those earnings, the E in the P/E ratio, that helps keep it at a moderate level and not going into bubble territory, is being spent on AI. If more and more of the E is being spent on something else, rather than being used to buy back stock, which they've done to an extraordinary level over the past few years, how will that affect the share prices of the Mag 7? But for now, all that AI spending is serving to boost GDP economic growth, which the Atlanta Fed's Now Tracker has at 3.9%. Have a great week.